Hey, Tyler, I think a lot of times investors think of utility stocks, these forever businesses. You can buy it, you're going to get your yield that they pay, it's going to be stable, and it's worth just holding. If you want that stable, dependable income, you want the safety, you want the security. NextEra Energy is a bit of an exception here, that it's not only a utility, but it's beaten the pants off the market since its IPO, the past 10 years, the past 20 years, just about any way you slice it, until maybe the past 2 or 3 years when the story hasn't been as good. You and I recently, we did a video, Tyler, looking at NextEra Energy Partners, its subsidiary, and we talked about some risks to it that could make it unappealing for investors. I think it's time to talk about NextEra Energy and why what's going on with NextEra Energy Partners, why it's a potential warning sign for investors in NextEra Energy. Tyler, before we get to that video, though, I should probably tell the people watching this who I am and why we're here. I'm Jason Hall. This is The Smattering. I want to mention, too, The Motley Fool is our sponsor. And after this video, if you want to get some even more great stock ideas, go to our special link, fool.com/The Smattering. The Fool's got its 10 best stocks to buy right now. Tyler, what is going on with NextEra Energy, and why should investors be cautious right now?
So NextEra Energy, like you said, smacking the pants off the market for 20 years, which if you were to look at all the utility companies at their total returns, NextEra Energy just stands out as really exceptional outcome related to a lot of other utilities. And a large portion of why that happens is because it has two businesses. There's a regulated side of the business, Florida Powered and Light, slow growth businesses regulated by the state. So the state tells them how much they can invest, the type of return they can get on that. And it's never a high growth business, but can be wealth compounding over a very long term. What NextEra Energy has on top of that is this unregulated business. And a lot of it is the development of renewable power assets, some natural gas, but the bulk of the focus lately has been solar and wind power energy. And just to give an idea of the difference here, 5, 6, 7% is typical good utility kind of earnings growth. Adjusted earnings for its energy resources business, that unregulated side of NextEra Energy, in the most recent quarter was 14%. You don't see that in utilities. It's a very uncommon outcome is to see earnings growth that high. Combine the two together, it had 8.6% earnings per share growth. That's an excellent outcome for utilities. Now, like you said, in a previous video, we discussed NextEra Energy Partners, which has been a financing vehicle. It's owned a lot of assets that NextEra Energy has developed, built up, and then once operational, sold a portion to NextEra Energy Partners as a way to finance, pay down some of the debt, let other investors take on some of the burden, some of the assets in exchange for a high dividend yield. It's a pretty good business, but a lot of that business is predicated on cheap capital. Past 10 years has been a pretty cheap capital environment. And when NextEra Energy Partners went public in 2015, there was one of those periods, and we've had it for quite some time now. With the higher interest rate environment that we have, debt costs more, right? NextEra Energy Partners is down about 30% this year. So the cost to issue equity is higher. This translates to financing things is more expensive. It makes me wonder whether or not NextEra Energy can continue meriting a huge premium relative to other utilities, because if it can't grow that unregulated side as quickly, then it's just another slow growth utility, right? And who's going to pay a premium for the same thing they can get elsewhere?
Utilities are an area where cost of capital and interest rates are something that more investors need to be paying attention to. You're right that NextEra Energy, maybe it affects more than most, because most people have pretty low expectations for the utilities that they own. If you look at the Utility Select Sector SPDR ETF, it's the utilities that are in the S&P 500. It's generated 140% total returns. That's dividends included, total returns since it was created. Over that same period, the S&P 500 generated 220% in returns, right? NextEra Energy, 341% in returns. It is an exceptional utility by all measures. And your point is spot on that cost of capital could affect it maybe in an outsized way because of its unregulated business. And I think investors need to be very conscious of that and maybe start, to your point, lowering their expectations for NextEra Energy. It has come down already, but it's still pricey. It's still more expensive than most utility stocks. I think you're right. I think investors should be cautious